All right, October has come to a close and we're heading into the last two trading months of the year. So in this video, I've got four spectacular growth stocks that you can buy in November. So let's get into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right now, starting with Amazon. Now, Amazon had a difficult time adjusting to the aftermath of the pandemic. It overinvested in capacity to serve the surge in customers the company gained, and cash flow from operations you can see declined considerably. But it's been bouncing back impressively in the last 6 months or so, and I think it's an excellent time to buy Amazon stock. Its forward price to earnings of 39.68 is not prohibitively expensive, especially when you consider the growth Amazon is achieving not just in revenue but also in profitability. Amazon recently reported its quarterly earnings update, and you can see the phenomenal results Amazon delivered. Net sales increasing by 13% to 143 billion. AWS sales increasing 12% to 23.1 billion and ending a four consecutive quarter streak of decelerating revenue growth for the segment. Operating income jumping by nearly 5x to 11.2 billion in the third quarter compared with 2.5 billion in the third quarter of 2022, and the net income for the third quarter included a 1.2 billion dollar valuation gain in its investment in Rivian, so that's working out well for Amazon as well. And finally, operating cash flow increased by 81% to $71.7 billion for the trailing 12 months compared to 39.7 billion in the trailing 12 months ended September 30th, and management is forecasting more of the same from Amazon in the next quarter. So things are looking bright for Amazon. The company is adjusting well now to the reopening economy and the normalized economy now that we're getting used to life after the pandemic. The next growth stock I'm going to recommend in November is Alphabet. Also, a company generating substantial cash flow from operations, 106 billion to be precise, in the most recent trailing 12-month period. And you can see the phenomenal trend going back 10 years. And Alphabet also not expensive, trading at a forward price to earnings of just 18.75. Alphabet also recently announced its earnings results. Again, excellent quarter from Alphabet. Revenue growing by 11% to 76.693 billion and earnings per share jumping to $1.55 up from $1.06. Alphabet has done a great job enhancing its products with artificial intelligence. A lot has been said about Alphabet being behind Microsoft in terms of AI. That might be true, but Alphabet is still doing a good job implementing and utilizing AI to enhance its services, including Google search and YouTube. And you're going to see more of the same from Alphabet going forward, even if it's in second place or third place or wherever it might be in the top 10, to be sure, in terms of implementing artificial intelligence to improve its business processes. Alphabet also announced and implemented mass layoffs in 2023. That's improved the cost structure. And so Alphabet delivered this 11% revenue growth and 50% growth in earnings per share, all with fewer employees, and that will boost profitability going forward as it has kind of slimmed the fat and reduced the waste and become more efficient in 2023. So now going forward, after the growth rates in the future will lead to better profitability for Alphabet. The third stock I'm going to recommend to buy in November is PayPal. PayPal generated 4.316 billion in cash flow from operations in the most recent trailing 12 months, and it's done a good job growing its cash flow from operations in the last decade, but it's had some difficulties in the last couple of years. Remember, PayPal benefited significantly when we were spending more time at home and shopping online more often, because that's when PayPal services are used more often, when we're shopping online. That's where it adds the most value, because you don't have to take out a credit card and put in your information when you're shopping at a new website. If they accept PayPal, you could just log in with your PayPal account and use that to make the purchase, saving you time and convenience, and that's where it really adds value. Now, PayPal stock has been under pressure in 2023, trading at a forward price to earnings of 8.986. Some of that pressure was due to the lack of a new CEO, but they solved that issue a couple of months ago, naming and hiring a new CEO. And the other side of the problem has been a contraction of profit margins in its transaction side of the business. And so I think that's been an overreaction. You could see PayPal in its latest quarter. It hasn't updated the third quarter earnings just yet. It'll come out in November. But for the second quarter, it reported 7% growth in revenue to 7.3 billion, and management said that in the start of the third quarter, revenue accelerated to 9%. So in the first month of the third quarter, it was already off to a good start. Management was forecasting at least 100 basis points non-GAAP operating margin expansion for 2023, and management was planning to buy back $5 billion of stock. Now, I like to see companies buy back their stock. It tells me that management thinks their shares are undervalued. And when you look into the marketplace and you see the stock is trading at just a forward price to earnings of less than 10, you're encouraged to see that management is going out and buying the stock at these cheaper valuations. So I like to see that. And finally, the last stock I'm going to recommend to buy in November in this video of 4 spectacular growth stocks to buy is Roblox. And Roblox is an interesting one, right? The company benefited significantly during the pandemic, as well as more kids were spending more time online and cash flow from operations boomed. But that's come down a bit since the economic reopening gained momentum. Still, the company generated a strong 388 million in cash flow from operations in its most recent trailing 12 months. And for Roblox, I use the forward price to sales ratio because the company is not profitable on the bottom line, but that's for an interesting reason, which I'm going to share with you in just a little bit. But Roblox's price to sales ratio forward at 4.905 is the cheapest this stock has traded for going back until January of 2021. So you're getting it at a good valuation. Now, here's what I meant about Roblox's interesting reason for not being profitable on the bottom line, or at least one of the reasons it's not profitable on the bottom line. Here's the way Roblox recognizes revenue. And so if a user, or when a user spends $30 on the Roblox platform to purchase 3,000 Robux, the company doesn't recognize that $30 as revenue immediately. It recognizes it as $30 of bookings. Only $1 of revenue is recognized per month for the next 28 months. So it assumes that this consumer that just purchased the $30 of Robux is not going to spend it for the next 28 months, or is going to spread out that spending over the next 28 months. It assumes only $2 of revenue immediately. It assumes that they're going to purchase $2 in consumable virtual items, which it recognizes as revenue immediately, but the durable virtual items, the other $28, it recognizes as revenue over the next 28 months. And so it takes a longer time for Roblox to recognize the revenue from when consumers put the money on the platform, and that makes its revenue look worse than it actually is, and that makes its profitability look worse than it actually is. So you might say, why does Roblox choose this reporting framework? And partly because it might be required to, and partly because it also outsources these items. It outsources its development of the games and items on the platform. So if Roblox recognizes the revenue over 28 months, that probably also means that it can pay the developers over the next 28 months as well, instead of paying the developers immediately, right? Because Roblox promises developers a percentage of the revenue that their games generate. So by spreading out this payment, it makes for a more preferable cash flow for Roblox as a company. It gets this deposit up front, the $30, it has that cash, and then it uses the accounting to slow the way it pays out the cash to the developers. And yes, it might make its earnings look worse, but at least the company gets to keep the cash for longer. And so that helps the cash flow for the company, which in my opinion is more important than the profitability for the company. So for that reason, its profitability looks worse. But when I look at the company overall, it's growing millions of daily active users. It's done a good job keeping all of those players that it gained during the pandemic. And it's the leading provider of metaverse platform worldwide. So I'm bullish on this company, and I think it's one that you can go ahead and buy in November. So there you have it, 4 spectacular growth stocks you can buy in November. Now, before I let you go, if you've gained any value from this video, please subscribe to the channel. It'll really help me make more videos just like this one. Thank you so much for watching.